The American economy has been outpacing several of its rivals, particularly in Europe, where gross domestic product growth has cooled in recent years. A major explanation for the difference in the countries comes from consumer spending differences. Americans buy things. A lot of things. I made a video on it over the summer, and many of those points still ring true today, but a key piece of evidence has come out from the New York Federal Reserve that might explain how Americans are able to keep up their consumption spending when Europeans are choosing not to. And no, it doesn't have to do with inflation, so let's get into it. When the COVID pandemic hit, many people were forced to stay home in an effort to stop the spread of COVID-19. As a result of that, people's consumption tanked. We stopped spending on gas, we stopped eating out, we stopped traveling. You get the picture, you were there 3 years ago. When consumption tanks, personal savings rates rise. In the US, the personal savings rate more than doubled from 2015 to 2019's 6.4% savings rate to 13.6% during 2020 and 2021. This savings rate phenomenon was observable in other foreign countries too. In the Fed's blog posts, they note that the rates of Canada, UK, Japan, and the Euro area all see similar patterns to the United States. Post-2021, however, the patterns diverge. In the US, we are now saving less than what we saved during the pre-pandemic period, whereas the other countries noted are all saving above their pre-pandemic levels. In essence, Americans are burning through their stockpiled savings while the rest of the world has decided to hoard it. One thing you don't need to hoard, though, is the usage of that like button, and consider subscribing for more business and economics content in the future. The Fed goes on to show a method on how they calculate these excess savings. That is, the savings that were accumulated beyond what we would have expected if the pre-pandemic savings rate continued and the COVID pandemic never happened. As we can see from the graph, in the years since the end of the pandemic, the blue line representing the Americans has shown a decline as Americans have spent down those excess savings. But the red line shows that foreign countries have remained relatively constant since the pandemic. The New York Fed then looked at the U.S. real consumption and real disposable income measures, indexing them against 2019, and compared that to the pre-COVID 5-year trend. Essentially what that means is the red line and blue lines on the graph tracked with the yellow one, then they would have continued following the pre-pandemic trend of the real consumption spending and real income in that time frame from 2019 to present day. Real income or real consumption, meaning that this is accounting for inflation, of course. Looking at both the foreign and United States graphs, we see the massive temporary dip in consumption during the COVID lockdown. In the US, we see that real consumption has generally returned to follow that average trend line, but we see that real disposable income has lagged below it. But if consumption is still up, then that means Americans are drawing on their savings to keep consuming. In the foreign comparison, we see that the consumption has not kept up with the trend. And in fact, even though real disposable income is as bad as the United States real disposable income index, their real consumption remains below it, which is why we see those elevated savings rates from earlier on. Of course, this type of all else equal exercise requires caveats. It could understate the boost to the economy to the extent that this extra consumer spending has a multiplier impact by raising growth and employment above what they would have been in the US. And conversely, it could be overstating the boost to the extent that the extra spending that the US is doing is allocated to imports, which would not be reflected in the consumption measures. So what does this mean going forward? If the US savings rate had remained at the pre-pandemic average values, then real consumption would then be about 3% lower than at present for the given level of income. By itself, this would leave real GDP about 2% lower than what it currently is. And that would certainly be a murkier economic picture than the one that is playing out currently. Not that consumers in the US are feeling particularly confident at the moment. Speaking of consumer confidence, that is one mystery that the New York Fed opines on in the blog post. Generally, savings rates are higher when people are feeling uneasy about the economy and spend more freely when they feel more secure. But according to measures constructed by the OECD, U.S. consumer confidence has been weaker relative to long-term norms than confidence in other high-income economies, which would be consistent with higher savings in the U.S. and lower savings abroad, which is the exact opposite of how this is playing out now. If the New York Fed's excess savings calculation is correct, it seems like there is still plenty more excess savings to draw down on in the US, which means that any ideas of recession could be suspended for now. That, of course, assumes that excess savings are distributed equally and well enough to allow that to happen, which may or may not be true. So we'll just have to keep a close eye on consumer spending as we head through the remainder of the year. The holidays are usually big spending months, so if those numbers are flat or down relative to last year, it could be seen as a turning point. Wait, what's that? I'm sorry, I'm just getting word that the most recent retail sales data shows retail shopping is up 0.7% month over month, smashing the expectation. So it looks like the savings-fueled spender bender isn't over yet. If you like this video, let me know in the comments if you've altered your spending patterns in the recent months or not. Also consider checking out the one on the screen now. Thanks for watching, and I will see you in the next one.